Hello, good day. We are the Group 10 and we are going to discuss about the Chapter 10 Cost of Capital Estimations and the Discount Rate. So in this chapter, these are the objectives. Estimating the cost of individual sources of capital, the difficulties of estimating the cost of equity finance, target gearing ratios, and the weighted average of average cost of capital and its practical relevance as a discount rate. So in chapter 8, the group 8 took a brief look at typical sources of long-term finance of UK businesses. Now we shall see how it is possible to make estimates of the cost to the business of each of these individual sources. Since logically the discount rate to be applied to the expected cash flows of the real investment opportunities with the business should be the opportunity cost of finance to support the investment. This discount rate must be related to the cost of individual sources in some way. In fact, using various sources of finance, weighted according to the importance of each source to the particular business, seems to be regarded as a standard means of determining discount rates. Evidence suggests that this weighted average cost of capital approach is widely used in practice. McLaney, Poynton, Thomas, and Tucker found that weighted average cost of capital, or WACC, is used in investment appraisal by 53% of UK-listed businesses. They also found that nearly 80% of businesses reassess their cost of capital annually or more frequently. As we shall see later in this chapter, many businesses mention in their annual reports that they use WACC as the discount rate. The standard approach is to estimating the cost of specific sources of capital is based on the logic that the discount rate is amplified by the current value of the financial asset concerned and by future expectation of cash flows from the specific asset. This is a popular approach in practice, although for estimating the cost of equity, its popular is decreasing. So, the cost of individual capital elements. An economic asset, or which loans, tax, equities, and so on are to their owners, has a current value equal to the value of the future cash benefits from ownership of the asset, discounted at a rate commensurate with the timing and risk of each of those cash benefits. That is the formula. C is the cash flow associated with the asset. R, the rate of return, and N, the time of each of cash flow. To a loan creditor or shareholder, the future cash flows at any given moment will be future interest or dividend receipts, payable annually, biannually, or perhaps quarterly, and perhaps a repayment of the principal at some future specific date. To a loan creditor or shareholder, the future cash flows at any given moment will be future interest or dividend receipts payable annually, biannually, or perhaps quarterly, and perhaps a repayment of the principal at some future specified date. So logically, a rate of return to the investor represents a cost of the business concerned. Therefore, we can make general statement that the formula K, the cost of capital to the business, and P, 0, the security's current market price. So loan notes or loan stocks or debentures. With stock exchange listed loan notes, we should know that the current market value of the loan notes, the contracted interest payments and dates, and the contracted amount and date of the repayment of the principal. Thus, in the valuation expression above, we should know all of the factors except K. Solving for K will give us the cost of capital figure that we require. So, this is an example of 10.1. So loan notes that were originally issued at par are currently quoted in the capital market at £93 per £100 nominal value. Repayment of the nominal value in full is due in exactly 5 years' time, and interest at 10% on the nominal value is due for the payment at the end of each of the next 5 years. What is the cost of the loan notes? Assume a 30% rate of corporation tax. So this is the statement. So this is the solution. So since we are seeking to deduce a rate that can be used to discount after tax cash flows, we need an after-tax cost of capital. The loan notes interest would attract tax relief, but the capital repayment would not because it is an expense. The following statement holds true. So 93 equals 10 times 1 minus 0.30 over 1 plus K plus 10 times 1 times 1 minus 0.30 over 1 plus K to the power of 2, then plus another, so on until to the power of 5. So where K is the after-tax cost of loan notes. So here, solving for K will give us the required cost of capital figure. We have met the situation before when deducing the internal rate of return of an investment opportunity. Of course, K is the IRR of the loan notes, and hence the solution is only discoverable by trial and error, but this could be achieved using a spreadsheet. As annual returns of net £7 are worth £93, a rate of less than 10% is implied. Let us try 8%. Then it seems that the cost of capital is above 8%. Let us try 9%. Thus, the cost lies very close to 8.8%. So, some readers may be puzzled as to why when the original amount borrowed was £100, the amount to be repaid is equally £100 and the coupon interest rate is 10%. The cost of the loan notes is not 10% before tax or 7.0% after tax. We should remember that our purpose in calculating the cost of capital is to derive a discount rate to apply to investment projects. In previous chapters, we have seen that the appropriate discount rate is the opportunity cost of capital. This means either the saving that would follow from repaying their capital source or the cost of further finance raised from the source. At the present time, this amount would be 8.8% after tax. If the business wishes to cancel the loan notes, it can do so by buying the notes in the capital market at £93. This would save the annual interest payment at 7.0% on the nominal value and avoid the necessity to repay the capital after 5 years. If further finance is to be raised, presumably the same business could raise £93 for loan notes that pay £10 at the end of each of the next 5 years, plus £100 at the end of the 5th year. So in either case, 8.8% is the appropriate rate. We might also ask why investors were at one time prepared to pay £100 for loan notes that yield £10 in interest. The difference must arise either from the interest rates having increased generally and or from the capital market having changed its perception of the risk of default in payment of interest or principal. Thus, a particular business cost of capital is not necessarily static over time. Given capital market efficiency, the cost of any element of capital is the market's best estimate of that cost for the future. Perpetual loan notes are occasionally issued by businesses. These are loan notes that have no repayment date and which will, in theory, continue paying interest forever. Their cost of capital calculation is similar to, though simpler than, the calculation for redeemable loan notes, where each of the C values is identical and n goes to the infinity. Where t is the rate of corporation tax, this can be written as k equals c times 1 minus t over p LO. Thus, in the above example, if there will be no repayment of principal but the annual £10 interest payments were to continue indefinitely. Then, term loans. With term loans, a major means of business borrowing and unlisted loan notes, there is no readily accessible figure for P that can be put into the valuation model. To deduce K, logically P should be the amount that the borrowing business would need to pay immediately to induce the lender to cancel the loan contract. Alternatively, it is the amount that could currently be borrowed given the future payments of interest and capital it is obliged to make under the terms of the loan in question. In theory, these two should be alternate routes to the same value. For P, in practice, that they may not be. The real problem is that, equal or not, in practice P is not readily observable. So some estimate of it needs to be made. In practical terms, unless the value of the loan is particularly large and or there have been major changes in interest rates since the loan was negotiated, the contracted rate of interest would probably serve adequately as the present opportunity cost of the source. Alternatively, an estimate based on observation of current interest rates could be made. Next is the finance leases. As we saw in Chapter 8, a finance lease is in effect a secured term loan with capital repayments at intervals during the period of the loan, rather than all at the end, where it is not explicit in the lease contract. We can discover the interest rate fairly easily. The value of the lease at the date of its being taken out is the cost of the asset that is the subject of the lease. Since this figure and the amount of timing of the future lease payments can be discovered, K can be discovered. To identify the present cost of a lease later in its life, we should need to take a similar attitude to that which is necessary in respect of term of loans and listed loan notes. We could try to put some current value on the lease and solve for K in the valuation expression. We could, however, assume that the current opportunity cost of the lease finance is more or less the same as it was when the lease was first taken out. Trying to value the lease at some date after it has been in operation for a while, it's likely to be a fairly difficult task, so we are probably left with making the assumption that the interest rate implied by the original contract is still appropriate. Alternatively, some estimate of rates applying to current new leases could be used. Assessing the cost of using hire purchases to provide part of the finance is achieved in much the same way as with financial leases. Next is the preference shares. The calculation of the cost of preference shares is almost identical to that for loan notes. The major differences between the two financing methods are as follows. Interest on loan notes attracts corporation tax relief. Preference dividends do not. Loan interest is paid under a contractual obligation. Preference dividends are paid at the discretion of the business directors. The first point simply means that the tax should be ignored in the calculation of the cost of preference shares. The second implies that rather more uncertainty is involved with predicting preference in dividends than with predicting loan interest payments, although this creates no difference in principle. Next is the ordinary shares. Ordinary shares too are similar to loan notes. In the basic calculation of the cost capital, ordinary shares have a value because they are expected to yield dividends. How, if at all, the pattern of dividends affects the value of equities, we shall discuss in chapter 12. Example: dividend and cum dividend. So, before we start detailed discussion of dividends and how they are linked to share prices, a few words need to be said about the basis on which shares are traded in the secondary capital market. Normally, shares are traded cum dividend, which means that anyone who buys the share will receive the next dividend paid by the business concerned. When a dividend is imminent, the business concerned will close its list of shareholders and pay the dividend to those shareholders appearing in the list. In other words, the shares go ex-dividend. This means that anyone buying the shares after the date will not receive particular dividend. It will, however, be paid to the previous shareholders who have sold their shares since the close date. This is despite the fact that those investors will no longer own the shares on the dividend payment day. Not surprisingly, the price of the share falls by the value of forthcoming dividend as the share moves from being traded cum dividend to being traded ex-dividend. Whenever the current market price a share, P, is used in an equation relating to dividends and the cost of equity, we must use the ex-dividend price if a dividend is soon to be paid and the shares are being traded cum dividend. We need to deduct the amount of the forthcoming dividend per share to arrive the equivalent ex-dividend price. Deriving the cost of equity. To say that equity should be valued on the basis of future dividends is not to assume that any particular investors intend to hold a particular share forever, because the proceeds of any future disposal of the share will itself depend on expectation at the date of disposal of future dividends. If a business is expected to pay a constant dividend D per share at the end of each year indefinitely, the value of each ordinary share will be the formula to the investor who needs to hold the share forever. Suppose, however, that the investor intends to sell the share of the time T, its value at the time will be. This would mean that the value to our shareholder would be the formula. That is, the value depends on the dividends to be received until T, suitably discounted plus the market value at the time, T discounted at 1/1 plus KET, to bring this market value to the present value. This expression reduces to. Hence, irrespective of whether disposal at some future date is envisaged or not, provided that valuation always depends on dividends, the current value will be unaffected, unlike loan interest, which is usually fixed by the contract between borrower and lender, and preference dividends, which businesses usually endeavor to pay and for which there is defined ceiling. Ordinary share dividends are highly uncertain as to amount. This poses a major problem in the estimation of the cost of equity. The prediction of future dividends is a daunting task. One of two simplifying approaches may be taken, however, assumes that dividends will remain as at present, or assumes some constant rate of growth in them. If the first of this is adopted, a similar approach is taken to that for perpetual loan notes, that is, the formula which, when all dividends are equal, means if we assume a constant rate of growth G, then which reduces to where D1 is expected dividend per share payable next year. This is known as the Gordon growth model after the person who derived it. Texopic, in its 2007 annual report, stated that in its estimating its cost of capital, it assumes an annual growth rate of 3 to 4%. McLaney, Poynton, Thomas, and Tucker found that 28% of listed UK businesses use a dividend approach to estimating the cost of equity. Of these, 75% include a growth factor, almost always a rate of growth based on a past trend. Al-Ali and Arkwright found that 21% of larger UK businesses use the dividend approach. Graham and Harvey found that 16% of the U.S. businesses surveyed use this approach, with smaller businesses more likely to adopt it than larger ones. Note that CAPM has become the standard way to derive the cost of equity. In practice, this is despite its severe weaknesses. Example 10.2. So, a business ordinary shares are currently trading at £2 ex-dividend, which is each in the capital market. Next year's dividend is expected to be £0.14 per share, and subsequent dividends are expected to grow at an annual rate of 5% of the previous year dividend. What is the cost of equity? So the solution, if a fixed proportion B of funds generated by trading each year is retained as opposed to being paid as a dividend, and the funds are reinvested at a constant rate, then rate of growth G equals B times R. Then, assuming either that dividends will be constant on the one hand, or that the rate of growth will be constant on the other hand, is clearly unrealistic. In practice, dividends tend to increase from time to time and to remain steady at the new level for a period before the next increase. These particular assumptions need not be made, although they provide a practical, if an inaccurate, way of estimating the cost of equity. So, retained profit. As was made clear in Chapter 8, a retained profit is not a free source of finance. It has an opportunity to cost to shareholders, because if such profits were to be distributed, shareholders could use them to make revenue-generating investments. It would be incorrect, however, to deal with retained profits separately in deducing its cost. When we derive the cost of equity, we are deriving the cost of the entire equity, which in effect includes retained profit. Thus, provided that the cost of equity is properly derived, the fact that the equity is part share capital and part retained profit will automatically be taken into account. Convertible loan notes. Convertible loan notes may be viewed as redeemable loan notes on which interest will be paid until a date in the future when they will be redeemed by their conversion into equities. Estimating the cost of convertibles is therefore a similar operation to valuing loan notes, except that the redemption amount is unknown to the extent that we do not know what the equity share price will be at the conversion date. As with estimating the cost of equities, we can make some assumptions. For example, that the equity dividends will remain constant or that they will grow at a steady rate. Example 10.3. The convertible loan notes of Tower PLC currently trade in the capital market at £140 per £100 nominal. The notes pay annually interest of £11 per £100 nominal and may be converted in exactly 5 years' time at a rate of 50 ordinary shares in the business per £100 nominal of loan notes. The present price of the ordinary shares is £2.20, which is expected to grow by 5% PA over the next 5 years. What is the cost of the convertible loan notes? Note that the corporation tax is charged at 30%. The price of the convertible PCO is given by where I is the interest payment in each year until conversion in year T, PEO dash current market price of an equity share, G the growth rate of the equity price, the conversion R the conversion rate, and K the cost of the convertible. In this example, we have £140. So, solving for K by trial and error gives about 5.5% as the cost of the convertible finance. Note that 5.5% is an opportunity cost, since Tower PLC should be able to issue some more convertibles with similar terms and exempt to issue them at £140 per £100 nominal. Or if the businesses were to buy back to its own convertibles for an investment of £140, it could gain £11 less tax each year for 5 years and issue the shares of cash in 5 years instead of using them to redeem the loan notes. This would represent an annual return of 5.5% to Tower PLC. Warrants are valued similarly, except that the returns from the warrant continue after the equity is taken up. So, weighted average cost of capital, or WACC. So, we have seen how the cost of individual elements can be estimated from current capital market prices and prediction of future cash flows associated with the element concerned. Most businesses use at least two of the financing methods that we have considered, and each is likely to have a different cost. For example, to the capital market investor, loan notes tend to be much less risky than equities. In the same business, expectations of returns from equities are therefore higher. Given this disparity in the cost of various elements, which discount rate should be applied to the estimated cash flows of prospective investment projects. Target gearing ratios. Evidence shows that generally businesses have a target ratio based on capital market values of the various financing elements. In other words, a particular business seeks to keep equity finance as a relatively fixed proportion by market value of the total finance. Similarly, it seeks to keep loan type finance as more or less a fixed proportion. Minor variation may occur from time to time, but businesses are believed to take steps to get back to target as soon as it is practical to do so. Marsh found that in practice, most businesses maintain a stable capital structure and appear to have a target gearing ratio. Ozkan, studying 390 UK businesses over the period 1984 to 1996, concluded that generally businesses have a long-term target gearing ratio. Businesses seem rapidly to readjust their gearing to meet this target whenever they find themselves diverging from it. Graham and Harvey found that 81% of the U.S. businesses surveyed them in 1999 had a target gearing ratio. Just under half of these had a flexible target. Larger businesses and those with investment-grade loan notes tended to have more rigid target ratios. Some, though not many, businesses state that they have target and even what it is in the annual report. Their annual report, for example, in its 2006 annual report, the oil business British Petroleum plc or BP stated its intention to maintain its gearing within the range of 20 to 30%. So it is believed that such target ratios exist because businesses taking account of such factors as levels of interest rates, tax advantage of loan interest relative to dividends, and the stability of their operating cash flows decided on an optimal mix of financing methods which they then try to establish and maintain. Such targets are not presumably established for all time. Changes in interest rates, tax rules, and so on may cause a change to a new target which may then rule for several years. Targets will also vary from one business to another, partly because of differences of opinion from one set of management to another. Such differences may also partly, perhaps mainly, arise from differences in the nature of the trade in which the particular business engage. The objective of trying to establish and maintain an optimal balance between various sources of finance, and indeed that of raising finance other than from equities at all, is presumably to try to minimize the cost of capital, which will maximize shareholder wealth. Whether such attempts actually work is a matter to which we shall return in Chapter 11. Meanwhile, let us go back to the question of the choice of the discount rate. Using WACC as the discount rate. If we make three assumptions, then using the weighted average cost of capital as the discount rate is logical. So there is a known ratio for the financing elements which will continue for the duration of the investment project under consideration. The cost of the various elements will not alter in the future from the cost calculated, and the investment under consideration is of similar risk to the average of the other projects undertaken by the businesses. Then, using the weighted average cost of capital as this. Then, using opportunity cost implies at the saving financing cost that would arise if finance were to be repaid rather than the investment project being undertaken. Alternatively, it could be seen as the additional cost of raising the necessary finance to support the project. If there were a target, repayment of finance or additional financing would be carried out in accordance of the target. For example, suppose that a particular business has a target debt equity ratio. Of 50-50 by market value. If that business is to take an extra finance to support an investment project, it will in principle do so in same 50-50 proportion. Otherwise, it will disturb the existing position. Similarly, if the finance for the project is available but it could alternatively be repaid to suppliers, presumably 50% would be used to cancel loan notes and 50% to paid to ordinary shareholders, perhaps as a dividend. The three assumptions stated at the start of this section are all concerned with the fact that in investment project appraisal and any other case where we may wish to assess the cost of capital, it is the future cost that we are interested in. The third assumption relating to risk perhaps needs a comment. We know from a combination of intuition and casual observation of real life that the required rate of return cost of capital depends partly on the level of risk surrounding the cash flows of the investment project concerned. It is not appropriate, therefore, to use a WACC based on a past involving investment project of one risk class. As the example 10.4 calculation of WACC, Hazelwood PLC is financed by 1 million ordinary shares, nominal value £1 each, which are expected to yield a dividend of £0.10 per share in 1 year's time. Dividends are expected to grow by 10% of the previous year's dividend each year. The current market price of the share is £1.80 each, and £800,000 nominal loan notes which pay interest at the end of each year of 11% of nominal for 3 years, after which the loan notes redeemed at nominal value. Currently, the loan notes are quoted in the capital market at £95 per £100 nominal. The corporation tax rate is 30%. What is the business of WACC? So first, we must find the cost of each of the individual elements. Ordinary shares, here we can apply the Gordon growth model. Cost equity. Then loan notes, we must use our IRR type trial and error here. We have the equivalent of an investment project where an investment of £95 now will bring an interest £11 less tax, that is £7.70 net at the end of each of the next 3 years, plus £100 at the end of the third year. The discount rate that will give you 0 NPV looks as if it is below 10%. Try 8%. So the solution, loan notes. So the appropriate discount, so this is the part letter B of loan notes, in which 9%. So clearly the appropriate rate lies close to 9%. A closer approximation may be obtained, but it is doubtful whether there is any point in seeking more accuracy than the nearest whole percentage, 9%. That this is because the cost of other element in the financing ordinary share has been calculated making some fairly sweeping assumptions about future dividends, and the cash flows that will be discounted by the resulting WACC cannot be predicted with any great accuracy. So we may say then that the cost of the loan notes K equals 9%. Next, we need to value the two elements. Ordinary shares, the total value of ordinary shares, V 1 million times 1.80 pound equals 1.80 million. Loan notes, the total value of the loan notes, 800,000 times 95 over 100 equals 0.76 million. Now that we have cost and values of the two financing elements, we can go on into calculate WACC. Note that we used market values rather than the nominal values of the two elements as the weights. This correctly reflects the fact that we are seeking the opportunity cost of capital. Market values reflect or indicate current opportunities. Nominal values do not. Despite this, Ali, and Arkwright found that 21% of large UK businesses use nominal values as the weights. So, realities of raising finance and the discount rate. Although businesses seem to establish and maintain a target gearing ratio, the practical realities of raising and repaying finance are that it is not always economic to raise or pay each £1 or additional or reduction in finance strictly in the target proportions. This is because, as we have already seen in Chapter 8, there are quite large fixed costs associated with raising long-term finance, particularly with share capital. In practice, businesses seem to raise fairly substantial sums from each issue in order to take advantage of the economies of scale regarding the issue cost. This would tend to have the effect that the target is a factor around with the actual ratio hovers. In the example, the current ratio of loan notes to total finance for Hazelwood PLC is 21.7%. That is 0.76 over divided by 180 plus 0.76. Equity currently accounts for 70.3% of the total. This suggests a target ratio of about 70 over 30 if the businesses wish to raise £1 million, say, to finance a new investment project. It is most unlikely that it would raise £700,000 in order to share in ordinary shares and £300,000 in loan notes. It is much more likely that it would raise the whole £1 million from one source or the other. This would move its gearing ratio away from the 7 over 30 approximately that currently exists. The business would get nearer its target by raising the following increment of finance from the other source. The pattern would probably be something like that depicted in figure 10.1. Here, the broken time represents the target ratio with the points 8 representing consecutive actual financing configurations. The business starts by raising some initial equity capital, followed by borrowing amount AB, perhaps through a term loan or an issue of loan notes. It presumably chooses not to raise. since figure Since there are economies of scale in share and loan notes issue cost, businesses tend not to raise each tranche of new finance in the same proportion as the target gearing ratio, but either totally from equities or totally from debt. This means that the actual gearing ratio will tend to follow a path that wanders from one side of the target to the other. Rarely will the actual and the target gearing ratio coincide. Points A, B, C, D, and E represent actual gearing at various times, whereas the dotted line represents the target. Specific cost or weighted average. The fact that a particular increment of finance is to be used in some particular project should not lead the business to use the specific cost of the finance as the discount rate. Say, in the case of Hazelwood PLC, that the funds to finance the project were to be raised from an issue of loan notes at a cost of 9%, it would clearly be wrong to use 9% as the discount rate in assessing the project, in the same way as 16% would be inappropriate were the finance to be raised by an ordinary share issue. To use 9% would mean that a project that might be acceptable if the businesses were moving from point C to point D in figure 10.1 might be rejected if it were moving from point D to point E. When a 16% cost of equity rate would be used, this would clearly be logical and could lead to some bizarre investment decisions. It would be much more logically used WACC provided that the business intend to maintain a broadly constant gearing ratio. So next is practicality of using WACC as the discount rate. So using WACC as the discount rate for a project is quite a logical approach at the same time as being fairly practical one. There are some points that need to be recognized. However, these are problems with estimating the inputs to identify the cost of individual elements. This tends not to be too much of a problem with debt finance, where there are listed loan notes, the current market price, and future cash flows, interest payments that are set by contract can be known with certainty, provided that we are satisfied with that the market that sets the price is efficient, and the evidence that we reviewed in Chapter 9 suggests that it is. This should provide us with a reliable cost of loan notes financing. Even with non-listed loan notes and other forms of borrowing, we can probably estimate the cost of finance fairly accurately. Our problem tends to lie mainly with the cost of equity. Again, we use an efficient market set price of the shares. This is, however, combined with an estimate of future dividends. This latter factor is a difficult one. WACC, in the way that is normally estimated, tends to be forward focused. Since it is to be used to assess possible investment projects, WACC needs to be forward looking, that is to be the future cost of capital. By combining a market set price for loan, stock, and equities with estimated future interest and dividend payments, we do achieve this. Market prices of securities are based on investors' estimates of future interest and dividend receipts. Next is WACC and the particular project. It is generally acknowledged that higher risk would be expected to provide higher investment returns. A potential problem arises from using WACC as the discount rate. The estimated WACC is inevitably calculated on a business-wide basis, not on a project-by-project basis. The estimated WACC may therefore be inappropriate for a project that is either more or less risky than the average for the business as a whole. There are two approaches to trying to deal with this problem. Estimate on the basis of the particular project's perceived riskiness by how much the business-wide WACC needs to be adjusted to be appropriate as the required rate of return discount rate of the particular project. Find a business that specializes exclusivity in projects of the same nature and therefore riskiness as the particular project, and use that business WACC as the discount rate. Next, WACC values used in practice. To put things into perspective, Dimson, March, and Staunton estimate that is inflation-free, returns on equity for UK businesses over the whole of the 20th century average about 6.5%. PA, this is in effect the average cost of equity. Since most businesses have significant element of borrowing, the debt tend to lower WACC, we might expect that the rates actually used by UK businesses would not be as high as 6.5%. Recent survey evidence indicate the mean real WACCs found in practice in the UK to be in range 7% to 9%, though many individual businesses estimate that WACCs at values outside the range. Table 10.1 sets out the WACCs of some well-known UK businesses. 10.1 Table 10.1 WACCs of some randomly selected businesses. So businesses: Associated British Foods PLC, food manufacturer, WACC percent 9.5, BP PLC oil 10.0, Carphone Warehouse Group PLC 6.8, JD Weatherspoon 5.6, Kingfisher 6.9, Prudential PLC 9.6, and Tesco 13.5. So note that in some cases, businesses show a range of values that they use as their discount rates. The table shows the mean average value of the range where this is the case. The values found McLeany and others and those shown in table 10.1 seem on the high side. Given the findings of Dimson and others, it must be said that none of the businesses listed in table 10.1 indicates whether they are stating the real or money figure. If any of them are giving the money figure, this needs to reduced by 2 to 3% to obtain the approximation the real one. Presuming that WACC is used by the businesses surveyed as their discount rates for assessing investment, it might appear that valuable investment opportunities may be rejected as a result of businesses having too high an expectation of acceptable returns. Incidentally, it seems that an increasing number of businesses reveal their WACCs in their annual report. This practice used to be quite rare, but recently it appears that about a third of all businesses are publishing their WACCs. There are some other points that need to be made about using WACC as the discount rate, but since this requires some understanding of the contents of Chapter 11, we shall leave them until that end of that chapter. So that's all for our report. Thank you and have a good day.